Welcome back, everyone, to another episode of Financial Market Insights for Traders. I'm Sophia, your host, and today we're diving deep into a topic that's especially critical for new traders entering the fascinating yet challenging world of cryptocurrency. Crypto trading for beginners, managing volatility, and avoiding scams. Cryptocurrencies have undoubtedly reshaped the investment landscape in recent years, with Bitcoin and Ethereum frequently making headlines, attracting both institutional investors and everyday traders. It's easy to see why interest in crypto trading continues to grow. But with great opportunity comes considerable risk. Crypto markets are famously volatile, and unfortunately, scams have become increasingly sophisticated and prevalent. So today, we'll explore practical strategies and recent events to equip you with the tools necessary to navigate this exciting yet unpredictable market. Let's begin by tackling the elephant in the room: crypto volatility. In traditional markets, significant price fluctuations might happen over weeks or months. In crypto, these swings can occur within hours or even minutes. For example, just this past year, we saw Bitcoin plunge more than 10% in a single day due to concerns over regulatory crackdowns in the US and China. On the flip side, Ethereum saw rapid spikes around technological developments and increased adoption of decentralized finance, DeFi applications. To trade crypto successfully, managing volatility is not just a helpful skill, it's absolutely crucial. Let's talk about how you, as a new trader, can navigate this effectively. Firstly, diversification is your best friend in volatile markets. You might have heard the saying, don't put all your eggs in one basket. In crypto, this advice is especially potent. Instead of betting all your capital on a single token or coin, spreading your investments across multiple cryptocurrencies can help cushion the blow if one asset experiences a significant downturn. For instance, while Bitcoin and Ethereum are viewed as more stable assets within crypto, incorporating promising altcoins like Cardano, Solana, or Avalanche can balance your portfolio and reduce overall volatility. Another practical method for managing volatility is using stop loss and take profit orders. Imagine you bought Bitcoin at $30,000. Setting a stop loss at $28,500 can limit potential losses. Meanwhile, establishing a take profit order at $33,000 ensures you lock in gains once your target price is achieved. Utilizing these tools allows you to automate your risk management strategy, preventing emotional decision making, which can often lead to disastrous results. Speaking of emotions, let's address emotional trading. Crypto markets are driven heavily by speculation, hype, and the fear of missing out, FOMO. We've seen this repeatedly, such as during the meme coin mania involving assets like Dogecoin or Shiba Inu, where traders piled into assets due to social media frenzy, often buying at peak prices only to face significant losses afterward. Keeping emotions in check and adhering strictly to a predetermined trading plan can protect you from such impulsive decisions. Position sizing and controlled leverage are also essential in managing volatility. Although crypto exchanges often offer very high leverage ratios, sometimes up to 100 to 1 or even higher, it's crucial, especially as a beginner, to use leverage cautiously. The collapse of highly leveraged positions during recent market swings highlighted the danger of this practice. Trading with low leverage, such as 5:1 or 10:1, initially can help you gain experience without risking excessive losses. Now that we've explored managing volatility, let's shift gears and address another critical concern: crypto scams. The cryptocurrency market, still relatively new and less regulated compared to traditional financial markets, unfortunately, makes it ripe for fraud and deceptive schemes. Scams in crypto can take numerous forms, from fraudulent initial coin offerings, ICOs, and pump and dump schemes to sophisticated phishing attacks and Ponzi schemes. Recently, we've seen high-profile cases like the collapse of FTX, one of the largest crypto exchanges, and several prominent rug pulls, where project creators vanished overnight with investor funds. To protect yourself, the golden rule in crypto investing is DIY, do your own research. When evaluating a new cryptocurrency or project, your first step should always be to scrutinize its white paper. A credible white paper should transparently detail the project's purpose, technological backbone, team credentials, and clear development roadmap. Red flags often include vague language, unrealistic promises, or missing critical information. Another critical step is evaluating the project team. Transparency matters. Projects with fully public, reputable teams tend to be more reliable. For example, legitimate projects usually showcase their team members prominently on their websites, including their professional backgrounds and LinkedIn profiles. On the other hand, anonymity or incomplete information should immediately raise caution. Market capitalization and liquidity are additional factors to consider. Coins and tokens with high market caps and trading volume typically indicate higher investor confidence and stability. They're also less prone to manipulation compared to smaller, less liquid assets. Smaller, obscure tokens with low trading volumes can often be manipulated by a few market participants, putting your investment at higher risk. Exchange listings also matter significantly. Assets listed on major, reputable exchanges like Coinbase, Binance, or Kraken undergo rigorous vetting processes. This provides an added layer of trust and credibility. Conversely, tokens only available on obscure platforms or decentralized exchanges, DEXs, without a strong user base could be riskier investments. Phishing scams remain a significant threat. In recent months, numerous traders reported receiving sophisticated phishing emails and text messages pretending to be from trusted exchanges. These scams typically trick users into logging into fake websites designed to steal passwords and private keys. Always double-check URLs. Enable two-factor authentication, preferably using authenticator apps instead of SMS, and avoid clicking on suspicious links or emails. When it comes to securely storing your crypto assets, hardware wallets, often called cold wallets, are considered the gold standard. Unlike hot wallets, which are connected to the internet and vulnerable to hacking, cold wallets store your crypto offline, greatly reducing the risk of cyber theft. While hot wallets offer convenience for active traders, large sums or long-term holdings should always be stored offline for maximum safety. Lastly, always be skeptical of promises or guarantees of exceptionally high returns with little or no risk. Such claims are a hallmark of crypto scams. Legitimate projects never promise guaranteed returns because all investments inherently involve risk. If a project sounds too good to be true, it most likely is. As we wrap up today's comprehensive discussion, let's briefly summarize our key points. Successfully trading cryptocurrencies as a beginner hinges on managing volatility wisely and diligently safeguarding yourself against scams. Through careful diversification, disciplined use of stop loss and take profit orders, controlled leverage, and rigorous due diligence, checking project legitimacy, team transparency, and market liquidity, you can navigate the crypto markets more safely and profitably. The crypto landscape offers tremendous opportunities but demands an equally significant level of responsibility, discipline, and continuous learning. By incorporating these practical strategies and staying informed, you'll not only avoid common beginner pitfalls, but also build a solid foundation for long-term trading success. If you're ready to take your crypto trading journey further, make sure to visit crystalballmarkets.com. Their platform offers valuable tools, comprehensive educational resources, and reliable trading services tailored specifically for retail traders looking to thrive in the crypto market. Thank you so much for joining me today on Financial Market Insights for Traders. I'm Sophia, reminding you to trade wisely, stay safe, and keep expanding your market knowledge. Until next time, happy trading.